Welcome back to the Carbon Exposure Project, where we dive deep into the people, policies, and pathways shaping the future of carbon markets. This week's guest is Oi-Yee Choo, the CEO of Climate Impact X. Her journey spans investment banking, fintech, and now climate finance, an arc defined by building trust and infrastructure in complex emerging markets. Oi-Yee began her career in corporate finance at Morgan Stanley, UBS, and Nomura. She later went on to lead iStocks, a digital securities platform focused on tokenization and private markets, before stepping into the world of carbon to lead one of Asia's most important market platforms. In this conversation, we explore the lessons she's carried from finance and tech, the momentum behind Article 6, and how ASEAN cooperation could help shape a more cohesive regional market. We also discuss what it will take to rebuild confidence in an industry facing both scrutiny and trying to achieve scale. It's a grounded, thoughtful exchange with someone who understands both the opportunity and the responsibility of building the carbon markets of tomorrow. Welcome to the Carbon Exposure Project. Oi, thank you so much for your time. It's a pleasure to get the opportunity to sit down with you, and welcome to the Carbon Exposure Project.
Well, thank you for having me. I see you've got a really interesting looking podcast on Spotify, and I'm going to follow that.
Oh, please do. It'd be great to have you as a subscriber. So that's fantastic.
But great to be on it.
But now you're on it,
Yeah.
exactly. So, look, it's great to have you on. I think I'm really looking forward to our conversation today. We've obviously been already chatting off camera. I think you bring this incredible diverse background from financial markets to carbon markets, and you recently joined our industry, so welcome. I wanted to kind of dive in to learn a bit more about you, who you are, your journey. It seems that most people that come into carbon markets share one thing in common, and that's there's no direct line drive effectively in terms of path to get here, right? That they find their way through this meandering kind of just path of life. And so how did you end up coming into carbon markets, and what's your background?
Yeah, no, thanks for that. You said recent, it literally is very recent.
Yep.
I've spent most of my career, it's been a long time, don't ask the age, but a long time in traditional corporate finance, investment banking, and in global banks. And it was a very interesting job. It sort of took me to different places and sectors. And at the sort of end of 2019, I kind of wanted to do something different.
Yeah.
Partly because, you kind of like after a while, I want to stop being on the sell side. I feel like there are many opportunities to sort of learn and grow. And I actually jumped into a fintech company and sort of did that for about 4.5, 5 years.
Yep.
And sort of took it to a certain level. It's got blockchain and tokenization and wealth and private markets. We can do a whole podcast about that.
Yeah.
But it was very exciting. I mean, it was sort of learning about new tech. How's that going to change the world? How did I apply what I had before, and learning sort of how do then I merge that with what my version of impact is. Right? And then I stepped down. I wanted to sort of take a break, think about something different. So that was sort of around May this year. So then I jumped off and I said, you know what, I'm going to just do nothing. I'm just going to take a break.
How did that work out for you?
Yeah, well, not very well. I started on big projects I probably shouldn't have, like a massive renovation of the house. I planned like a gazillion holidays, and then, sort of a few months later, I had a call, and they were like, well, would you like to look at this role? Which is, CIX. The ex-CEO had sort of stepped down a few months ago, and they were like, would you like to take this role? And I'm like, whoa, carbon markets, it's sort of, you sort of know it's sort of around the financial sector, and then it's not, right?
Yeah. It's a funny intersection.
It's a funny intersection, I agree. And so I thought, okay, I'll just take a look at it. And it was people that sort of knew me quite well, as in the person who sort of thought that I would be a good candidate, knew my management style, knew my history, and said, I think it's quite a good role for you to consider because, you have what we need and stuff like that. And she knew I was up for the challenge. I think that was the most important. So I started sort of exploring the role and met the board and the team, and I was like, oh, this is really interesting because it was sort of the same early evolution stage as tokenization.
Yep.
And so the same, they're completely different, by the way, but the same challenges,
sure.
right?
But markets also in their infancy, let's say, or in adolescence, trying to figure out where they're going.
Exactly. What business models do you have? How do you influence the broader ecosystem? How do you pull ecosystem together? How do you make TradFi come alongside what you do? How do you work with regulators? How do you then build the ecosystem? How do you scale it? How do you commercialize? So I look at this space and I'm thinking, oh, kind of like looks sort of the same with very different, stakeholders, but kind of the same. So I kind of, when you start biting into it, you're kind of like, I couldn't let it go.
Yeah.
So I went down the rabbit hole, dug a lot deeper, spoke with all the stakeholders, and they were like, no, this is very interesting. And of course, we have very interesting stakeholders.
Very interesting stakeholders. I'd like to unpack some of those.
Yeah.
Really, really big influences.
We could get there. It's actually, it was actually somewhat inspiring for me as well, that these stakeholders and these shareholders sat on the board, and they are the most senior, most influential people in the financial sector you could ever imagine. And this was their representation of impact.
Yeah.
To some extent, right? Part of the representation.
And they're patient capital as well.
And they're personally involved.
Yeah.
They're not just like, oh, this is a
portfolio company.
Portfolio company where, somebody else 5, layers down look at it. They're actually involved. So I was very inspired by that. And then, so I kind of, thought about it, looked at what I could do. And it was very important to me that I could value add as a CEO, right? Because you can't just jump in and kind of, sort of
But it's always interesting in those transitions, right? Especially a CEO coming in, because you have different administration preceding you, different culture, and then the company hits a certain kind of growth kind of pains, let's say, and then it requires a different skill set to take it to a different level. I think there's a maturity in terms of recognizing that potentially you're not at that capacity. I've certainly been in that capacity before, where I realized I've got to hand it to somebody else to take over, right? But then when those people do and they come in, it's intimidating, but they need to also put their stamp effectively. So how has that gone?
So it's been drinking from the fire hose, a whole chunk of that. And really, the company didn't really give me that much time, right? They're like, here's the access card, when I said yes, here's the access card, here's the, come in like tomorrow. And so, I spent a good part of the first few weeks sort of understanding the team and what was happening. And then really the next sort of week 3 was already FinTech Festival, where I was already getting into speaking engagements, talking about what's happening in the space. And then the week after that was Baku, which was phenomenally exciting. It was interesting. There's so many things happening. And so it was really in that 2 weeks that you really get everything. So it's been cool. We've been back now, so it's a bit calmer. And then it's year-end planning. So that's been good, pulling together what we've learned, what we want to do.
That's a hell of a crazy first 90 days.
I mean, seriously, insane, insane. But it's been really, really fun. And a lot of that is, I think, in a new evolving space, you make many friends.
Completely.
Right?
That's one thing that I have to say about our industry. It is sometimes self-defeating in terms of overcomplicating things, and I think we need to acknowledge that. We love 3-letter acronyms, like just to like ad nauseum. It's ridiculous. And I'm over the TLA soup. But one other thing is that people have come from diverse journeys to get to this place, and they feel a sense of urgency and a sense of motivation to be here. So there's a level of camaraderie and mutual respect that you don't see across other other commodity markets in particular. So environmental commodities are very unique in that context. But because it's climate related, there's so much like pulling in the same direction. That's just really wonderful, and hence openness to new ideas, new perspectives.
Well, and also the willingness to teach and the willingness to sort of give you that group hug, as it were, right? Like it's like, oh, come.
You're one of us.
You're one of us.
It's very cultish almost.
But it's true, right? You kind of want to. You feel the need to explain to someone what you do in the simplest manner, so I've come through these meetings and people are so wonderful.
Great.
They're like, we understand you're new to this space, and here's what I think you need to know.
Okay.
Right? And it's a bit like, oh yeah, okay. I mean, nobody, because it's quite intimidating also to sort of say, I'm a CEO, I know everything, when in reality I don't.
Yeah.
And I think the more open I am with that and say, what do you mean by that?
But that shows maturity in terms of leadership style, right? Because it's clearly this is not your first rodeo. Ask a lot of questions and be learning from the different stakeholders, which is great.
So it's been super fun, sort of layering not only the financial institution lens and the sort of the exchange lens to this, capital markets lens, and then the running a 40, 50-man company. So it's kind of like, I always feel like being a CEO is a bit, I'm sure you feel that way, schizophrenic.
Oh, it's completely
You
schizophrenic.
kind of like, at the one hand, you have to be short-term, like, tactical moves, and then, talk about people issues, and they're always like this, and then you kind of then tomorrow have to like
go up to the
pull
mountain
yourself
and its
up.
strategy and then 30,000 foot
Think
view.
about, what are you going to do
Yeah.
5 years down the road? What do you look like 5
It's
years down the
lonely
road?
at the top.
Yeah.
Yeah, the crown is heavy.
Well, and
I
pulling
know.
people alongside of
Yeah,
that,
yeah.
right? So I'm glad this is not my first CEO rodeo.
Yeah, because then they threw you really in the deep end.
Yeah, yeah.
This time you're prepared.
Yes,
Fantastic. That's
Yeah.
cool. So, okay, well, so welcome again officially to the industry. It's fantastic to
thank
actually
you.
have you in. I want to dive into some of your experience because obviously you wouldn't have gotten this role had it not been for your track record. And apologies, obviously, for you not being able to take some time off. It sounds like you as most
tried.
high-performing people, decide, I'm going to take a sabbatical and then have some time off and focus on me. And then it's like, no, I need to be busy and do projects. So thanks for stepping into the deep end. But so let's go a little bit back if you can. Your background. You mentioned obviously investment banking and then working in fintech. I want to unpack whichever area you want to go.
Yeah, you know what? When I started in investment banking some time ago, it was just like, oh, okay, finance is interesting, but actually corporate finance and investment banking are hugely interesting because you're working alongside corporates, right? So at some level, you're talking about what IPO or how you should structure IPO, but at some level, you're really advising the company and sort of working with them quite closely. And so the familiarity in working through boardrooms and senior people are one part of that.
Yeah,
But the
not just the
second
access
part
to
of
capital markets, please.
the access to capital markets becomes very interesting because you then have to learn demand and supply almost at its visceral level.
Yeah.
And the way flows work, and as we talked a bit about flows and sentiment, and how does that all come together in how you advise a company to think about capital raising and whether and what modalities of that goes. So to some extent, and I was very fortunate because in those days, the REIT market was actually just developing in Asia and in Singapore.
Yeah.
And so that was actually my first eye-opener. I didn't think about that until quite recently, by the way. An eye-opener into how sort of a single shift in technology and regulation created a whole new asset class. If you think about it, right?
That's a really interesting parallel. Can I stop you there? Because I have conversations with folks from as diverse backgrounds as imaginable, but we talk about corollaries with regards to fixed income and the potential for capital and accessing that kind of capital markets. We talk about kind of how my previous guest was talking about how the access to capital for a lot of project-based financing is akin to venture capital, where there's a lot of equity component. But there's a lot of growing up to do in carbon, because even though it's carbon finance, the finance has always been secondary. It's been about climate and carbon with this technical kind of nous and focus. And the financial kind of acumen has been secondary to a lot of folks. And then on the infrastructure side, exchanges and other folks that are coming in are trying to bring more of that sophistication in. But no one that I've spoken with has actually brought out the parallel of REITs. So I really want to dive into that.
Well, it sort of occurred to me, and this occurred to me actually when I was doing the blockchain stuff.
Yeah.
But it actually applies across to these kind of sort of bubbling new asset classes. Is that it needs that transition of regulatory either harmonization or clarity.
Yeah.
And
then
just
to have unified rules.
Yeah, and then if you think about REITs, what happened was the REIT rules came up, and obviously there were favorable tax regimes and technology, because the exchanges then provided that democratization element of what was traditionally investment, sort of institutional grade investment.
Slower moving.
And it's fractional. You think about it, right? It's fractionalizing institutional grade property.
Yeah.
And I was like, oh.
So that democratization enabled a wave of participation and unlocked huge quotients of capital. Yeah, and provided much better liquidity and better pricing.
Yes.
Yeah.
Yes, exactly. So, and if you think about that, what does fractionalization or democratization do? Once you have that liquidity and pricing becomes very clear, then, and pricing and quality, you start to see the curve of price and quality. And I kind of say that very simplistically, right? Obviously,
no, but these
they're all
are
very complex. But
sure.
over time, when you have the depth of liquidity, which I think where we all want carbon markets to be, is to move from there to here. So tokenization is the same, right? And private markets are the same. So as I sort of learn all these things, and I kind of think in my head, oh, that's very interesting. So then I jumped into private markets. I left I was running UBS investment bank in Singapore, and I joined a fintech company, and I was doing wealth and sort of democratizing private market assets. And people would be like, oh, can you tokenize this? I'm like, you can tokenize anything, right? The technology isn't the problem. So now you have the technology is there. And you're kind of like, okay, but what does fractionalization of a private market, so they're like, oh, can we tokenize a portfolio of wine or whatever? I said, guys, come on, let's go back first principles. If you understand governance and you understand provenance and you understand valuation, you've kind of got it made, right? Let's not get into the weeds of this, that, whatever. If you understand these three, you can set up something. So then I'm like, oh, okay. So I kind of applying that to carbon markets a little bit. If you understand the provenance, you understand valuation, you kind of like, I mean, it's very, very simple things that you think about that make sense. So I'm like, okay, there's actually a lot of things I can apply from the traditional capital markets world, from the public to the private to carbon. And so that's kind of, I think that it was not so much a track record.
But it's about learned experiences and different
apply
perspectives.
That across.
Yeah, and I think that's what's been missing, because oftentimes what ends up happening, and it kind of came to this, coming back full circle to the cultish metaphor, but in cults and then little silos begin to develop, right, in industry, and then you end up having groupthink of effectively the same perspective, the same type of people, and effectively you have this bias of viewpoints. And what happens in a growing market is that you have these very volatile kind of growth spurts, which we underwent in sort of 2020, 21, 20, and 22 tail, like beginning of 2022, I should say, that then ultimately led to an influx of new participants, which then proliferated a whole bunch of new ideas and created friction inherently. And now we're dealing kind of with the aftermath of that. But that's great. You need to challenge those paradigms. Otherwise, you stay static and you never change.
Yes. And I think these different perspectives are very... Because of carbon markets sort of where it is, the VC markets where it is today, I think we're seeing sort of a outflow of talent. I think we need that re-inflow back of talent, not just from the traditional carbon market space, but
from all
more
markets
thinking. And it is really because I think we need the depth of liquidity and transparency. If you think about big corporates, not kind of jumping into the carbon markets, but big corporates, they have big sustainability teams. And they can choose projects and they can do due diligence and maybe even fly to Kenya to see the projects. Right? They can do it. And they have their scientists and they know what to do with it. So that's great for big guys. But what about the small companies? I mean,
what about the big tail of like the medium? If I'm looking at distribution, the tail end of like the bottom 90th percentile don't have that because they don't have the manpower. They don't have the luxury of having all of that expertise internally because they just don't have the balance sheet to warehouse that.
And today,
how do those people deal with the complexity?
Exactly. Yeah. So I think they just kind of freeze at it and go, I'm not doing it.
I think that's a really important point. I want to like double tap that because I think that is what then leads to the illiquidity in the market. It's a risk aversion that says, whoa, this is very complicated and I'm very worried that I'm going to purchase the wrong thing here.
And say the wrong thing.
Or say the wrong thing, make the wrong claims, and then I'm going to end up on the front of a newspaper. And I don't want that because what's the risk outweighs the benefits in this case. But it's not. Right, and when we bring better rigor and better transparency to the market, we can actually mitigate those risks by providing more of that granularity. It's like the greatest, disinfectant essentially.
Yeah. So one of the things that in Baku, there's a lot of discussion, and my sort of conclusion coming out of that is, first of all, we do need regulatory clarity. Yeah. And the regulators need to have the backs of the people they want the funding to come from.
Yeah.
Right?
Okay. So you can unpack that for me.
Yeah. So, if the governments around the world are saying we don't have enough money to fund this,
Yeah, I think that's an evident truth that is often not spoken, that the public sector cannot do the heavy lifting alone,
Yeah.
and that to think that just policy will just, snap its fingers and come up with a policy and then be able to underwrite it all through
No, that's not
subsidies,
gonna
etc.
happen.
They don't have the balance sheet. They have
No.
aging populations around the
Yeah.
world. They just can't do
Yes.
it. So they need to have the private sector engagement.
Yes.
So private sector needs what? They need transparency and they need clear rule sets in order
Yes.
with which to engage,
Yes,
correct?
exactly.
And time horizons that allow
Yes.
for investment decisions to be made.
Yeah. So I think and they're not harmonized and normalized. Some people have a certain carbon tax regime. Some
Yep.
people, with the EU ETS, so it's also a bit different.
Yeah.
And
Yeah, we have a proliferation of lots of different systems. Do you think that though, after Baku, we've waited almost 10 years for essentially implementation
Yeah.
of Article 6, which is great because, in Glasgow we got the Article 6 rulebook, and
Yeah.
then we're now having the implementation, right?
Yeah.
Do you think that now we have a clear path forward with which policymakers can actually choose their direction? And there's harmonization. You said harmonization a couple of times.
Yes, I have. And it's needed. I'm not
Yeah.
saying it's there. I think that if you sat at the Singapore booth for long enough, I think you feel like there is a lot of momentum.
Yeah, but Singapore, like Switzerland and maybe Sweden, and it's a very small group, have made a lot of efforts with regards to the bilateral engagements under Article 6.2 because they weren't willing to just sit around and wait. And they also saw an opportunity being effectively, in the case of Switzerland and Singapore, small, in the case of Switzerland, landlocked country, but in Singapore, an island nation, fairly limited resources. They have a natural look outwards. They look at themselves as hubs within a regional context or global context, whereas a lot of other countries are islands unto themselves, big economies that can substantiate their own kind of path and look inward oftentimes. Singapore and Switzerland in particular look outward, and therefore they looked at this opportunity under 6.2 to build bilateral relationships and effectively create the roads onto which these things can actually run, correct?
And
so I would imagine that optimism would have been pervasive at the pavilion.
And if you saw the panels and who came from Singapore to go speak there was a lot of pride in that booth, and I was actually very proud to be at that booth.
Well, you should be. I think what Singapore's doing is really amazing in terms of thought leadership and demonstration supporting a broader ecosystem.
And it's a whole
punches way above its weight in terms of pound for pound.
For sure. And I think what we quite see is we see the different ministries sort of all leaning in, and of course sometimes that is fast and sometimes that is slow, but the fact is it's a multi-ministry approach, which is very interesting to me.
Honestly, it is, and it's actually fairly unique. There's dialogue and there's knowledge sharing and there's a combined goal that they're operating towards, which honestly, a lot of other more advanced, like larger economies, let's just say, don't have that. They tend to have a lot of infighting between different departments, and they tend to have antagonistic kind of relationships oftentimes. And you think, because the department of such and such, fill in the blank, is putting this forward, another department kind of undermines it, and you kind of get this status quo, effectively not moving forward. Whereas in Singapore, it's a unified front. They're all pushing in the similar sort of directions, like a vector pushing forward.
And I think the topic around, obviously Finance Corp, as Baku was called. I mean, it got the space very exciting on, I think it was the Thursday, was like Finance Day. So this whole discussion around the funding pieces and all of that, I think were very interesting. The second thing that was actually very interesting was not only about the financialization of carbon, but also the fact that week 2, which sadly I couldn't stay for, the ASEAN associations came together to sign a memorandum of cooperation. And so it's not just about Singapore. I think the region has aspirations to at least try and work together as a bloc. Now, I think there's a lot of work more to do to really think about that interoperability. How do you actually put that into real practice? I think there's a lot more
fungibility of the
to
various different instruments, etc.
Can you imagine ASEAN countries coming together and agreeing on a MOC? Actually,
honestly,
it's a
yes, I can.
phenomenal
I got a preview of that because I was fortunate enough to go to Kuala Lumpur earlier in the year and sit down with Wei-Yee and her team over at BCX and kind of got a they're amazing and I got a prelude in terms of what that would mean for an incoming Malaysian presidency for the ASEAN region and honestly, So I can imagine it, but I think a lot of other folks don't, because they feel like, okay, maybe there's competing tensions between this region of friendly neighbors, but friendly competitions, kind of like brothers and sisters, cousins, right? They compete. But I think actually, when I look at regionally, obviously you've got the big European bloc. Obviously, that's a unified front in terms of policy and lobby, and they've got an entrenched policy framework with the EU ETS and now the cross-border adjustment mechanism, the CBAM. But when I look regionally, globally, like it's just this region effectively doing a lot of stuff. You don't see a lot of cohesion within LATAM, certainly not within Africa. You see contingents, little tiny splinters, but not at a regional level. Whereas in ASEAN, I think that there's a lot more opportunity, and perhaps it's because there's a recognition that when you look at the equatorial belt and then you look at where the nature-based resources exist, it sits in this part of the world as well as in the Amazon and in the Congo Basin. So this is a region that is benefiting potentially from carbon pricing because they can become effectively net exporters, right?
I think that's right. And that's why it's sort of, I'm like, oh, okay, how do we as Singapore, as a region or part of the region, lean into that and make sure we, sort of make our friends and relationship and partnerships across the ASEAN bloc, right? Because that itself is very powerful. And so kind of that was the takeaway from Baku, is that, hey, I know people sort of say, and people warn me, right? They're like, oh, you're going to go to COP and you're going to be very excited. And then you're going to come back and then you're going to be like, oh. And, look, I haven't got there yet.
I don't want you to get jaded so early into this tenure.
But
look,
I know,
a lot of people do get jaded, and look, when you look at it historically, it's taken a long time. Like since 1992, the Rio summit, where climate change was first sort of raised as a policy tool. But there's been a lot of just a lot of friction and resistance for a very long time. I think that we've pushed beyond a lot of that resistance, and now there's a harmony with regards to where we're at in terms of direction. The rate limiting step is the capital piece, but I just think you tapped on it before. It's a realization that governments can't do the heavy lifting solely by themselves, and that there's an opportunity here for the private sector to really provide a lot more of that leverage, because decarbonization is a mega trend that's not going to go away. We need to do it, and we need to do it over the next 30 years.
So sort of coming back around that, the more that I think governments can support with clarity,
and
it needs to give the smaller. So first of all, we agree. Governments can fund this. They want a broader embrace of the situation, and they want everybody to sort of be very conscious of that. Now, you can nudge it in many ways. You've got carbon tax, you've got, maybe a equivalent of an EU ETS. It doesn't matter, right? But the clarity around what companies can do, can claim, can, offset, I think it would be very important to give corporates confidence to do it.
Yeah, completely.
Some of the big guys who are doing it don't even want to talk about it, right? But they are sort of like putting pressure on the vendors to do it. Do you know what I mean?
I know exactly what you mean.
So the vendors are like, oh, but
I'm feeling pressure all sides. What do I do?
What do I do? So I think that's important to realize, but also to help smaller business understand their pathway. Is not to give them the variety of complex technicals that are now within the space, right? Because for a small corporate, how are they going to decide?
Drowning in too much information.
Removals, what's the difference? Why is there a price? How do I choose? What do I do? And how do I sort of even get there? How do I not get scammed? How do I know that how do I know how to retire a credit? You know what I mean? Like all these questions. And I think the this is a bit like stock exchanges when you didn't have an electronic stock exchange, right? You just basically trusted a guy to kind of like,
take your slip and then make sure you got your deal. And then you got your paper exactly. At the end of the month.
So now it's like the opportunity to say, well, this market needs transparency and depth and liquidity, and the more that we can layer on like a semi-compliance Article 6 should.
It's a trust layer.
Yes, a trust layer, and we have a standard. You have kind of like a central venue or central venues for that. People then trust the venue, and then people can say, okay, I don't need to know the 5 things that go into the standardized contracts, but I know that I can apply this when I need it, right?
So they research it the first time, they understand it, then they participate and they sign up and subscribe to be able to take delivery of those contracts. But now they know what they're getting. Right? It's within these constructs, and I think
it's sort of a
It's a knowable basket of what's being delivered.
Right?
Yeah.
We'll use that word.
So okay, cool. I love all of this conversation in terms of where we're going. So it's kind of come back full circle for me as well, because obviously, my background at Expansive, familiar with launching standardized instruments. So, but now you're sitting at the head of Singapore's national exchange, right? And you talked about trying to allay some of the complexities that the corporate clients are facing in terms of the lack of bandwidth, the aperture, however you want to term it, and then the complexity in the market.
Yeah.
Exchanges clearly have an important role to play to, one, and we touched on it, to kind of demystify and simplify by providing standardized instruments.
Yeah.
Then centralizing that pool of liquidity is a really key important component, providing that trust layer that you kind of mentioned.
Yeah.
So how are you seeing it now, coming back to your day job, right? In terms of your role moving forward, you're sitting at a pretty interesting vantage point.
Very interesting.
Yeah.
The tide's gone out. Okay, in the last 2 years, the tide's gone out, and exactly because the base of buyers, the base of corporates don't have that confidence.
Right? How do we encourage them to come back?
That's a good question. Well, that's a good question. Hold that thought for a moment. I think the corporates, therefore, that it kind of now it's polarized. So when the smaller mid-sized corporates don't buy, there's no support for the financial institutions to trade, because at the end of the day, they're the ones who rely on, there are two ways a corporate can do it. Themselves,
the financial
a
institutions
marketplace,
provide liquidity, but they do so for a premium, or they're putting capital at risk. So they want to trade, but if there's no underlying market, then they're not really trading. So it's this kind of double negative, and you slow down.
So, our observation is that the big corporates actually are still buying. There's quite a lot of the big leaders in the industry are starting to influence their value chain, because they're going to start reducing the different sort of scopes, right? And they kind of there's a soft power sort of going down right now.
Okay, great.
But it's still in very select industries. I wouldn't say.
Sure, but supply chains are infinitely complex.
Very
so
complex,
it touches one directive from a very large big corporate with a lot of buying power tends to affect a pretty big effect on its supply chain. So that's good to know.
Increasingly, as we speak to corporates, I spend most of our time with financial institutions, but starting to see a lot of corporates who have buying needs across, and we're listening to them a lot to understand where they're going, why they're buying, and we're getting really good insights to that.
Great.
That one is sort of a bit more buy and retire.
Okay.
So it's kind of like, okay, but we know that actually there's still demand.
Underlying demand.
And it's likely going to softly sort of start to increase, because everybody's going to start to push down their own value chain, right? So I think that's quite interesting. But more importantly, I think is understanding what the next few trends are. And it is likely in the transportation industries. It is likely around carbon taxes that are starting to pop up in the different regions. It is likely that Article 6 would push everyone to think about that interoperability and what does that actually mean? How do we open up a deeper market for that? And standardized contracts feels like it is becoming an interesting place to move towards as we move into these. When you say Article 6, you're like, oh, okay. It's kind of, you could do a lot with it, I think, eventually. The question is, where do you start, who starts it?
It doesn't matter. Honestly, as an exchange, you have an opportunity to innovate and to lead. And worst case, you get the contract specs wrong, you can always scrap it and have another one. The reality is we need a starting gun to emerge in order to encourage more liquidity and participation, quite frankly, in the market. So I would definitely encourage you. I think that's the right attitude.
And I think it's about linking arms with everybody and saying, hey, we kind of got to move, and we've nothing to lose at this point. So it's kind of like, let's link arms. We got to progress, right? You cannot. One of the things Ravi Menon said in a speech was, perfection is the enemy of good. So let's stop waiting until we have that perfect solution. We gotta keep moving, and we gotta keep innovating.
That's pragmatism 101, which is ingrained into the DNA of Singapore, right? Yeah, I completely concur on that. It is the truth. We've been waiting around for a very long time as a collective and we just don't have that luxury of time. 2030 is fast approaching.
Yeah.
We're hitting 2025 in just in very, very soon.
Yeah.
And it is crazy. It's now, I know, to add to your kind of comments here in terms of, and I think you're absolutely correct in terms of the verticals that you identified, that a lot of the corporates that made commitments in 2020 made them further out to 2030 and 2040 and 2050, by 2050 net zero, 2040 net zero, and are realizing full well that, sure, they made some early gains, right, low-hanging fruit, but as they go up the marginal abatement cost curve, it becomes a lot higher, and they need these price externalities to underwrite some of these big capex and opex investments, and they just can't do it with the current pricing. And so now there's this kind of realization: we're not going to meet target in 2030, or definitely not 2040s, unless we're pricing that environmental externality and we have a price on carbon.
Well, and first, you can't even sort of turn around today and say, well, find me supply. That supply doesn't appear overnight.
Completely. That inelasticity, right? Lack of response. It's kind of akin to being in a racing car and putting down the throttle. You put the accelerator down, and then there's no response. It's like the torque curve just doesn't get, and then eventually it happens. I don't think people, even within the market, but certainly outside looking in, there's this kind of misnomer around this oversupply and under demand in our market, and that's relevant in very small pockets of the broader market. There's this perception that there's this oversupply of all of these old, what some folks love to term as junk credits, which really grinds me to death. But we'll put that aside. But that's not the case. As you said, it's really difficult. If you got a corporate mandate today that said, go and find me 1 million tons of carbon removals, both nature-based and tech-based, you're like, good luck. They don't make them. There's not enough in the current pipeline. Certainly not at spot. If you're looking out on a forward curve, great. Are you willing to pre-finance some of these opportunities?
Exactly.
No, we don't want to put capital at risk. We're not venture capital. Well, then great. You're going to have to provide offtake, and you're going to have to provide some sort of equity backing to those deals in order to get them off the ground. And that's the realization. Those projects take a long time to get registered, then have monitoring and reporting and verification, to all of the back and forth with the standards, the programs that are regulating these projects and credits before they come to market, and they're under pressure to basically increase the baselines, make it very, very stringent with regards to the issuances, so the potential supply is even dampened there, and it doesn't look that rosy in terms of potential for supply. So I think that we're just ahead of this perfect inflection point that's going to take on the market, where there's a realization that, the demand is a tidal wave that hasn't yet hit, right? The tide's gone out, to use your metaphor, right? But the tidal wave's coming in, and the response time for actually generating the supply is not going to be like immediate, and therefore you're going to have huge volatility with regards to pricing.
Exactly.
You're going to go from basically where we are today, which is very, very low pricing, to really high volatility, and then kind of find equilibrium as the markets react.
So everyone.
That's when we look at. That's an institutional view, right? So I'm putting my trading hat on for this, but that's how we see it, and it's kind of worrisome.
It is kind of worrisome. Well, it's actually also quite worrisome as, some of these folks who say, well, I don't need to do anything until 27, 28. And I'm like, okay.
Yeah, that's cool. No one ever got fired for not taking a risk.
Sure.
And they might, that person might not be, but
find?
Institutionally, they're not going to be in that position. I've spoken to a number of those as well. Had said, look, our commitments by 2030, maybe we make them, maybe we don't, but 2040, we've got no chance. So now they're saying, well, let's look further afield and let's try to firm up supply in the 2030s. Again, hey guys, newsflash, it doesn't just miraculously appear. Project developers are also running businesses. And if those businesses go under, or those people, that talent, was you mentioned, talent goes out, good luck trying to attract them back in when you need them. And again, response time not immediate.
And then if you wait too late and there's really short supply, guess what?
Huge price volatility. And that doesn't build confidence in the market. So what we're trying to do is future-proof the broader market. So are you just coming back to our conversation? Wanted to do a deeper dive in terms of what you mentioned earlier, in terms of what we need really as a collective, as an industry. You touched on a bunch of them. If I can just summarize. So in terms of policy direction, right? That clarity for the private sector to engage, because they need to understand what are the rules of engagement effectively. We could talk about quality, we could talk about other things, but maybe we start on kind of clear rules of engagement, policy directives.
Well, I think what's been very interesting is I think there are some corporates who have very sort of thoughtful approaches to this, and I come from everywhere: transportation, technology, etc., etc. And what we need is that government clarity, the lens. Doesn't matter what it is: carbon tax, what are the offsets, Article 6. I won't say it doesn't matter. It's probably 2 or 3 things that need to be clear. And then the corporates can go to the boards and say, well, this is, I think, what we should do to get to net zero.
And get a mandate.
I get a mandate, right? Because now there's too much challenge from the boards.
Yeah.
So you kind of got to, and a lot of them really want to sort of get to net zero as quickly as they can. And that's one way of doing it, right?
Yeah. But can I just pause you for 1 second there?
Yes.
So, and I don't mean to cut you off because you're on a roll, but it's important point to make is that without a carbon pricing signal, whether tax or allowance-based, cap and trade, or project-based, there's no way that these companies can actually achieve net zero. Let's just get that right out of the and just air out the dirty laundry here. Without that pricing signal, there's no way that they can actually make those internal abatements with the current pricing, right? You need to have a stimulatory price signal in order to go up that marginal abatement cost curve.
Yes, so there's a combination of that and the ability to sort of be very clear in the carbon accounting or the sustainability report as to what exactly they are doing, that confidence. And once you start, I mean, actually, I've never seen a sector that has so many tools for you to find out what listed companies are doing, right?
Yeah.
Or like, you can go dig up, allied offsets, for example, and see how many companies have retired credits.
Yeah.
So there's a whole bunch of actually publicly available data. And you're like, well, actually,
net zero
that should
tracker,
be,
there's a number of them.
There's a number of them. And you're kind of like, well, that should be actually very positive if we were focused on that positivity. Do you know what I mean?
I know exactly what you mean. Yeah.
You know that these companies are doing, so let's talk about what they're doing and why they're doing it, and really create that positive spiral of action.
Yeah, completely. And healthy competition. What ends up leading from that transparency with regards to data, and I was talking to a data analytics company in this space, I won't name them, but they see themselves as a data business, and they have auxiliary other businesses, whether that be ratings or otherwise, but providing that level of transparency in that data, then what they're getting now anecdotally is interest from their clients saying, how do we compare to our peers? So benchmarking within industries is another industry, a sort of extension of that, so to speak.
So with the sort of, at least with government sort of giving clarities and corporates getting more confident and sort of being a bit more visible in that, we want to bring back not just the I have to do it because I've got a carbon tax to offset.
Yeah.
I want to do it because I truly believe in net zero, and then sort of that I think will really help to bring the market back. That's sort of one appeal to the corporate good senses piece.
Yeah.
And the second is sort of, I think corporates need to understand, as sort of we just talked about, that 2050 is not that far away.
It's really not.
2030 is almost
a
5
pass.
years.
We're halfway point.
5 years is not a lot of time.
Completely.
And
if the last 5 years, which seem like the days and nights are long, but it seems that the years were long, but they're not. They're actually just flown by.
Yes.
Yeah.
And so I think companies need to start thinking that you cannot think for 2030 in 2028. And in fact, I mean, most companies have 5-year plans. So why are the sustainability teams saying, oh, actually, I have 5 years to think about it? You don't have 5 years to think about it. You need a plan.
Yeah.
And you kind of have no action. You've got to think about where are we going to for supply? How are we going to operationalize this?
Yeah.
How does that work? Pricing. Do we have a forward strategy?
Yeah.
And these things need to happen now, because the time that let's say you want to go very to the source and you're going to a project, you're negotiating with the project developer. That itself takes time, right? What kind of funding are you going to do? That takes time. The structuring and all that will take at least 9 months. So 1 year is gone.
Yeah, and then you got the latency with regards to what we were saying before around a project implementation to ultimately issuance.
Exactly.
You got delays as well.
Yes.
So the time is before now.
Yeah.
Yeah, it was yesterday.
Right. exactly.
Yeah.
So I think the other sort of really nudge I would say to corporates is don't wait until 2030 or don't wait until 2028. You got to have a plan now. And so I think with all of that, if people sort of wake up and say, well, actually, it's not that easy for me to find supply if I woke up one day and wanted to do it in a year's time.
Yep.
I think people will start moving. I think corporates will have to start moving. I think CSOs will need to have a 5-year plan.
Yeah.
I think
I hope that sense of urgency is heeded and really listened to, because it's the truth. I don't think that there's enough adequate supply to fulfill the current demand that's even being telegraphed today, let alone that has not yet emerged in terms of, from the shadows. And the response time to ultimately yield that supply, it's going to take a long, long time to just say.
Yeah. And I think maybe the industry to watch is the aviation one.
Yeah.
Again, bit of a high risk. I mean, it's moving and it's not as moving, but now we feel like there's actually momentum.
Clarity. Can I give you some context on that? Because it's an industry very close to my heart. My mum was an airline hostess, right? And I've benefited greatly from international transportation. I love air transport. And I've had the privilege of working with IATA and ICAO and many, many airlines over my career. And I really threw myself into the capacity building piece in 2017 in earnest within IATA, AITA, and then broader sort of ICROA, and then working with airlines ahead of what was adopted as the market-based mechanism that became CORSIA.
Yeah.
We had so much optimism in 2019 and then in 2020 when we first implemented, and then the pandemic kind of really undermined obviously the commitment that the industry made, just because of a once in a lifetime, once in a generation kind of pandemic that effectively grounded their fleet and effectively their emissions came down. They made a deal which was phase one to obviously take a 15% haircut. That's now implemented. We just came back from a conference in London with our team, went there, and a lot of airlines are like, well, 24, 25, and 26 is the compliance phase for CORSIA phase one, but we have until 2028, January 31 of 28, to submit our final homework basically to our regulators. And it's like, guys, you don't have another 3 years. You literally, if you have accruals-based accounting, you need to start planning and allocating for that now and speaking to your treasury. Because if you don't, you'll have a very big surprise for them in 2027 when they don't have the budget. And then more often than not, the airlines just are lacking the capacity to understand what is the available supply, and the available supply is minimal, as you know full well. And ICAO has taken quite a long time, very deliberate in its approach to approve programs and then ultimately now have the nomenclature within the registries to show that's CORSIA eligible. There's very little supply, and that market is forecasted to be undersupplied for the entire duration of phase one, given the current sort of emissions trajectory. 150 to 165 million tons is where we forecast that demand to be. That's sizable. And airlines also need to recognize that the carbon credits that are flagged for CORSIA eligible are not just earmarked for them to purchase. Can I tell you that it's like some of these people believe in fairy tales, and it said, but they're CORSIA eligible credits, they're for airlines. And it's like, you realize other corporates will buy these credits. You realize that there is competition from other sources, and they were like, no, we thought they were just for us. Newsflash, they're not for you. And I'm gonna look down the camera, if any airlines are watching, they're not just for you, they're for everybody. We saw that in the pilot phase. When we launched the first standardized contract at Expansive, the GEO, it's for specifically the pilot phase for CORSIA. And we made sure that, reflected the ICAO parameters for eligibility. That contract certainly saw some uptake from airlines, although they don't have the biggest balance sheets, so not unsurprisingly, they didn't take a massive quotient. Energy companies, telco companies, tech companies, you name it, went long and started buying these credits. Why? Because it was a quality marker, a point of differentiation. So if ICAO's quality marker is then received again in phase one as a high quality mark, maybe we see a whole bunch of different participants coming in and taking and usurping some of that supply, which creates more volatility and upward price pressure for that industry. So newsflash for airlines, like they better get ahead of it quickly and not defer till 2026, 27, 28, like God forbid, time frame, as you said, because then they face a non-compliance. But coming back to the kind of the policy directive, one of the things that really I think will be really a starting gun for participation under CORSIA is the for the non-compliance penalties. We're starting to see some in the UK and Brazil have been announcing non-compliant penalties for airlines not compliant with CORSIA. If we start to see a proliferation of that, where whatever the penalty is, that quotient of capital will find its way into the market because it's either we don't comply and we have to pay the penalty, or we comply and we get it at a discount. And any rational capital allocator will take that plan B effectively. So I think we need to watch out for that.
And that would be a very interesting playbook over time for a broader set of discussions, right? I mean, aviation is obviously one of them, but how about shipping and
shipping and maritime, absolutely.
That I think will be that second wave.
Yeah, the IMO has been a really interesting one to watch with regards to what's going on. You're absolutely right. It's funny because aviation and international aviation is so visible from a B2C perspective because we all fly. And so the brands, the airlines are all visible to us. So they have a lot of stakeholder engagement to do with the customer. So they are outwardly facing. But in shipping, it's part of logistics and supply chains. So it's B2B. So a lot of the times people don't know who's shipping the cargo. So they haven't felt that level of pressure to have one universal type of agreement like CORSIA did. The airlines saw that they did not want to have, and the rationale for CORSIA was very evident, that they did not want to have a patchwork quilt of different regulatory systems and regimes. One in China, one in Colombia, one in Brazil, one in Italy, and like all over the world. They didn't want that. They wanted to have one level playing field and no country left behind was one of their mantras. So that was what kind of led them to this. IMO has taken a different slant with regards to fuels, reducing sulfur and sulfates within fuels, and then kind of charting a trajectory towards decarbonization. I think they have a slightly easier path, quite frankly, than airlines, just because of physics. To get a plane off the ground and get the lift, you need the energy density, and you can't have the weight. And so you can't put like an electric plane necessarily off the ground for passenger cargo, passenger or cargo, I should say, because batteries just weigh too much, and so you can't get them off the ground. And they don't have the energy density per cubic liter or cubic centimeter. So you can't. So they still going to be reliant on hydrocarbons for the long haul. Whereas shipping, it's a big capex and opex like expenditure to tool and revamp a fleet, but they do have other alternatives for different fuel sources and potentially batteries and hybrid kind of systems. But nonetheless, these fleets
that all needs to happen. I mean, it's not just about the carbon markets.
But transportation is such an interesting industry overall, whether it's road, ship, or air, because they're very low margin, highly competitive businesses. So it's not like they're sitting on trillions of dollars of just free cash flow, right? As opposed to, for example, technology, right? Which is another interesting industry. I want to get your perspective on tech. There's a proliferation of very large, well-known tech companies that are participating currently in the carbon markets. You kind of alluded to it with large corporates. Your words were large corporates going out there and structuring deals on a project-by-project basis, let's say bilateral. And those are the big companies that have the sustainability teams, the scientists that you mentioned, et cetera, that can understand that, right? We know who they are. They're part of the Magnificent Seven, effectively, right? And these companies have and it's not name and shame. We're grateful for them market making, right? Like Microsoft and Google and Apple and Shopify, and it's like these are very active participants in this market, but they have a preference, interestingly, for carbon dioxide removals around the tech-based side of things. It's interesting. I want to get your perspective. Clients that we speak with that are not in the Magnificent Seven, that have a difference with regards to emissions versus, bottom line, balance sheet strength, tend to want and aspire to want to invest in these CDR projects, but they don't have the ability. So when you look at the proportionality or the distribution in their portfolios, I think it's more accurate. The CDR is a very small quotient of their overall footprint. How do you see it? Because it seems like CDR is this blossoming space for everyone looking outside. I just wonder, are you seeing those reflected on exchange?
Not as much. I think you're right.
Is it due to the primary market nature of bilateral, where you're not seeing it traded in the secondary, or is it that it's just a small volume that's actually minted or issued?
I think it's a combination of both.
Yeah.
I think the Magnificent Seven, or those that have big sustainability teams, are, I think, able to take forward a lot more of the thought process around. They have a bunch of scientists. I mean, and there's a lot of work being done on permanence and additionality, and so it's easier for them to come to that conclusion, and they have the reserves and the wherewithal to really deepen into that space.
Yeah.
And investing into that space.
I think also recognize their responsibility in this.
Correct.
To help market make.
Yes.
Yeah.
Well, the responsibility, I think, is to sort of find the right portfolio.
I think it's self-serving, but I also think that
themselves.
there's a certain level of venture capital kind of mentality that they're underwriting very risky sometimes methodologies and project proponents where they're getting involved early stage, knowing full well that it could go bottom up. And there's been instances where project developers that were really out of left field didn't deliver on the promise, and it's kind of a portfolio approach like in venture capital. You're gonna play the law of odds, right? And it's power law,
And maybe at some point, we're talking about how could we sort of get things going. Is maybe some of these big corporates should at some point allow for bigger syndication within either their ecosystem or supply chain.
Yeah.
Maybe, right?
I think we're seeing that, maybe.
Everyone benefits, a little bit, not as much.
I think, but there's a latency again, right? Like, undoubtedly, they're going to be putting pressure on their supply chains, which are inherently complex. Like, I talked to somebody in automotive about a year ago, and she was saying that the complexity, she was working at GM, in the supply chain, they had 30,000 suppliers, and each one of their suppliers has, tens of thousands of suppliers themselves. And so it's just like this crazy, family tree, just in terms of complexity of parts. So you can influence from the top and kind of distribute the pressure across that ecosystem.
You could.
So presumably that's one.
And maybe that helps, right? Because removals right now at a price level is just like significantly higher. And people, I think,
at least one order of
corporates that we speak
higher.
to, at least here, that are obviously not, at least the smaller mid-sized guys in town, tend to favor more sort of price reasonable options.
Yep, that makes sense.
And at the moment, it is not removals.
Yep. What about nature-based removals? Do you think that they're at a sweet spot?
I think they could be. Yes, they could be. They're quite a good segue into that. We do see biochar is one of those.
What about afforestation, reforestation? You guys have a contract on focusing on that.
Yes.
Do you see a lot of demand on ARR and also blue carbon? Anecdotally, we do on the trading side. There's a lot more demand and a lot less
more
supply.
Demand and easier. Well, it's sort of people understand that a lot better. So it's less of a slog in education and all of that.
Yeah, completely.
So kind of between price points and knowledge and education, I would love to support sort of that on the removals piece. I don't think removals, at least as far in at least the tech-based one, as a fully liquid tradable product yet.
It's
even
not.
In a standardized
you see
way.
super concentration in the market.
Super concentration. And a lot of these guys may not even have that much supply. So
no, it's all, and a lot of it's on the forward curve.
Correct.
Yeah.
And all long-term offtakes, and you don't. So as an exchange, we're kind of like, okay, let's wait for this market to deepen. But we're very focused on how this market evolves because we do see that as that next wave.
Yeah.
So we'll probably do a bit more education in 2025, have a lot more webinars with the right sort of projects. You get some feedback as to how the market's going to react to that in the near term.
Yeah. Great. Fantastic. I love this conversation. We're going all different, very multifaceted here in terms of what we're covering. So just obviously conscious of your time, and again, I really appreciate the opportunity to speak with you. Just kind of now coming to conclusion, in terms of optimism, where do you see the market going in terms of as we're entering 2025? I'll leave it to you.
Yeah, well, I was just saying earlier that, kind of like people tell me you're going to go to COP and then you come back and you're going to crash and you're going to be, oh. And I actually haven't found that yet.
Good. You picked a really good COP to go to. By the way, Baku is an amazing place.
Oh my goodness, amazing.
I was blown away how beautiful it is.
Yeah.
Clearly a lot of liquidity. But
I wish I spent more time.
I got there and I said, I called my wife and I said, we got to come to Baku. She's like, where even is that? I said, it's in Azerbaijan. She goes, I can't even say that. And I'm like, it's an amazing place. You got to come. It's like, it reminded me of Paris, more grand, which was ridiculous to say, right? Like I don't believe grander than Paris, and like Istanbul. It had this Eastern Western kind of vibe.
Yes. Right.
Oh goodness.
It's amazing.
Yeah.
And so coming out of that, even just sort of reflecting, I feel like there's so many pieces that could be worked on.
Mm-hmm.
It did leave a lot of questions, but
Sure.
I'm sort of focused on, you know what, we came out with more or less an agreement on what 6.4 looks like.
Yeah.
I think that's a starting point.
That's a great starting point.
That's a great starting point. I think we came out of it knowing that we have partners in the region who are equally committed in, I wouldn't say standardization, but harmonization and creating a bigger ecosystem within the region. And between ASEAN/Asia, 6.4, I think actually is there's so many things to sort of work on. Then obviously sort of you got to move towards sort of encourage, sort of how do you work with policy changes? How do you build partnerships? But at least now you can say, well, guess what? This is happening and this has happened. So actually we're like that step closer to working together. We're like that step closer to bringing this really as a real sort of thinking as like a fully tradable market, if you know what I mean.
Well, at least we've inched a lot more closer to that reality, right?
So much closer.
Yeah.
I think that's super exciting, by the way.
Great. I love that sense of optimism, but I think you summarized it perfectly. So I want to drink to that, a sense of optimism heading into 2025 for the markets really to come back as a result of strong foundations.
Absolutely.
Cheers.